We're here today with Sebastiaan Reinders, Senior Portfolio Manager of European High Yield. Sebastiaan, welcome.
Thank you.
Can you take us back to Q4? What happened in markets in 2014?
Well, Q4 was a very, very remarkable quarter, actually. There was a positive total return for the asset class, for European high yield, but actually there was a decompression between low and high credit quality issuers. So that means that companies that people perceive as being relatively safe, they actually did better than companies that are perceived as being risky, which is funny in an environment where people have been searching for yield for a very long time. Additionally, the US energy exposure that was there in the US high yield market, that has impacted also the European high yield market, more in a sell-off in sympathy manner. So I will come back to that later, but that's also where we did part of our trades. And next to that, the technical picture for high yield has deteriorated somewhat because of all this uncertainty and the volatility. Investment grade inflows, therefore, on the other hand, actually, they have kept very strong, very resilient, and investment grade buyers have kept on buying in the European high yield market, amongst others explaining this double B or the safer credit bias.
What about the impact on the strategy? Can you elaborate on that?
Yeah. The strategy is bottom-up driven and therefore very oriented to single B names, as that is where we see most value at the moment. But given that the single B, so the lower credit quality names, have performed less than the double B credits, that has explained, or that has caused some underperformance. Okay. That was offset by some idiosyncratic events, some company-specific or alpha, if you like, trades that we did that went in favor of the portfolio. For example, we avoided concession businesses, construction and concession businesses, that sold off because of their financial opaqueness, fakeness in financials. But we also avoided some of the defaults that were out there.
Okay, and what about changes? Have you made any of those?
Yes, we took the opportunity in the energy related sell-off to add some energy names where we could get fundamentally very comfortable with. So we did our homework, as always. We did our fundamental research, and we found that some credits that sold off in sympathy with US names that have oil exposure, that actually those credits are money good. And if you look at the business models, they simply work also at the low oil prices. So we've added some of that. What we also have done is that we have invested some of the inflows that we have been receiving from our clients in medium and high conviction overweights. So to make sure that those do not dilute with the funds becoming bigger and bigger.
Okay, and with regard to your outlook, can you share a bit about what your short-term outlooks are?
Yes, we think that the current positive momentum that's there for European high yield is here to stay. And especially after the most recent ECB actions, where they're putting in a lot of money in the market and taking out a lot of sovereign bonds, we think that will fuel the search for yield again. And also, if you look next to that, to the fundamental picture of the European high yield market, fundamentals are still very strong. They're stable, actually, and we expect very little defaults going forward. So the current yield levels, the current spread levels, because yield is actually fully spread, so fully credit risk compensation, they more than compensate you for the risk that's out there. So we think the market as a whole can return about 5% for the year, for the coming 12 months. But the fund can do much better, hopefully, because of its exposure to more spread-related risk.
Good to hear it. Thank you so much for joining us, Sebastiaan.